Thank you, Desmond. Hello, everyone. Welcome to our first quarter 2026 earnings conference call. The company's results were issued via Newswire services earlier today and are posted online. You can download the earnings release and sign up for the company's email alerts by visiting the IR section of our website. Mr. Tiezheng Li, Tim, our CEO, and Mr. Jiayuan Xu, Alexis, our CFO, we'll start the call with the prepared remarks and conclude with a Q&A section. During this call, we will be referring to several non-GAAP financial measures to review and assess our operating performance. These non-GAAP financial measures are not intended to be considered in isolation or as a substitute for the financial information prepared and presented in accordance with US GAAP. For information about these non-GAAP measures and reconciliation to GAAP measures, please refer to our earnings press release. Before we continue, please note that today's discussion will contain forward-looking statements made under the Safe Harbor provision of the U.S. Private Securities Litigation Reform Act of 1995. Forward-looking statements involve inherent risks and uncertainties. As such, the company's results may be materially different from the views expressed today. Further information regarding these and other risks and uncertainties are included in the company's filing with the U.S. SEC. The company does not assume any obligation to update any forward-looking statements except as required under applicable law. Finally, we posted a slide presentation on our IR website providing further details of our results for this quarter. I'll now hand over to our CEO, Tim. Tim, please go ahead.
Thank you, Yan. Hello, everyone. When we close out 2025, we said we were stepping into this year with clarity, not certainty. 1 quarter in, the clarity is beginning to show in the trajectory of our business and in the early results of disciplined choices we made last year. The macro backdrop has its challenges, yet we delivered a firm first quarter. Risk is recovering in China. Overseas business continue to scale with its own strength. And across the platform, years of technology investment are compounding into operating efficiency. Despite the typical seasonal softness in the first quarter, transaction volume held broadly steady at 42.6 billion RMB. Roughly in line with last quarter, our group net revenue reached 3.2 billion RMB, up 6% sequentially. Operating profit was up 13% sequentially. Net profit came in at 421 million RMB, up 1%, reflecting the impact of foreign exchange fluctuation. Overseas markets again delivered 30% of group revenue this quarter. This is no longer only a diversification story. It has matured into a second profitable engine. To give investors a clear view of this business, for the first time, we are disclosing our overseas business as a separate reportable segment. In the first quarter, overseas revenue reached 949 million RMB, up 35% year-over-year. Operating profit reached 46 million RMB, up 88% year-on-year. This is a reflection of both the scale we have built and the earnings power that now stands on its own. Now let me walk you through our 2 segments. Let's start with our mature market, Chinese mainland. The first quarter in China was, in a word, patient. We are seeing early signs of a recovery in progress. The Chinese New Year holiday always makes the first quarter a seasonally softer period. Yet transaction volume held up at 38.5 billion, roughly flat sequentially. On risk, we are seeing gradual improvements. The actions we took in the second half of last year are working, and credit risk is finding its way back to a healthier baseline. Vintage delinquency eased by 30 basis points. Day 1 delinquency ratio also improved, while 30-day collection rates ticked up. This improving environment has given us the operating headroom to re-engage with growth, cautiously, not aggressively. As the industry consolidated, some players pulled back. We selectively acquired more high-quality customers at compelling cost. Conversion improved. Acquisition costs came down, and we added roughly 0.6 million new borrowers in China this quarter, up 7% sequentially. In the near term, we will continue to closely observe the evolving regulatory landscape. There is still uncertainty ahead. Our approach is to stay aligned with the rules, manage risk carefully, and capture opportunities as they emerge. Now I walk through our overseas business. Our overseas market segment is a regional platform that learns, compounds, and transfers. Under our Lego Plus framework, the capability we build in our one market are deliberately designed to flow into the next. That means risk infrastructure, product architecture, customer strategy, funding relationships. All of these can be leveraged and replicated. This quarter is a demonstration of that idea in practice. The first quarter is traditionally a low season for our overseas markets as well. Across the region, transaction volume was 4.1 billion RMB, broadly flat sequentially. Indonesia moved through Ramadan. In the Philippines, we deliberately moderated origination ahead of new interest rate regime, taking effect in the second quarter. A measured decision, consistent with our playbook. Year over year, the direction is clear. Loan volume up 35%. Loan balance up 38%. Unique borrowers more than doubled to 4.5 million. Australia is unfolding on the roadmap we set. We are firmly executing the initiative we laid out from day one, expanding new customer acquisition channels, migrating the platform onto our proprietary risk infrastructure, deploying credit models and decisioning rules tailored for the Australian consumers. Early results are there: sharper risk detection, better borrower segmentation, stronger portfolio economics. What will make Australia work is the same combination that has served us before. Cross-market experience layered onto deep local knowledge. Technology. AI is no longer a supporting capability for us. It's how we run the business. From AI agents to workflow automation, we are proactively deploying nearly 120 active initiatives across the business, and more than 50% are embedded directly in frontline operations. For example, our engineering teams are building proprietary AI native infrastructure to support new product launches across our current and future markets. In some of our overseas businesses, the results are already tangible. AI collection agents are not only the default touch point for pre-due reminders. They are also handling 50% of early-stage collections at a recovery efficiency level in line with our historical benchmarks. We believe this is durable, compounding competitive moat, and we are just getting started. Community. Our long-standing community engagement programs continue to make an impact this quarter. Our micro business support program further expanded its reach this quarter, opening eligibility to retired athletes who run their own business in China. Since launch, over 140 small business owners have benefited from this initiative and upgraded their business with our help on operational and funding support. In the Philippines, our local platform partnered with multi-local institutions to combat fintech-related cybercrime, reinforcing our commitment to building a safer digital financial ecosystem. Together, these initiatives reflect the depth of our local roots and the consistency of our commitment to responsible growth. To close, the first quarter gave us the early shape of the year, a recovery in China amid regulatory fog. Our overseas business standing on its own with growth and profit, a technology advantage that is compounding. Against an uncertain macro, we move with the same posture we spoke of last quarter: clarity, not certainty; patience, not haste. We remain focused on growth that lasts and on creating durable value for consumers and our stakeholders. I will now turn the call over to Alexis.
Thank you, Tim. This quarter marks a meaningful evolution in how we report. For the first time, we are presenting our overseas operations as a separate segment. The reason is simple. Our overseas operation has grown into a business with its own scale, profitability, and trajectory. Reported alongside our China operations, the two tell a cleaner story. China is the foundation of cash flow and stability. Overseas is the engine of growth. Two engines, distinct but aligned. The overseas segment consists of Indonesia, the Philippines, and Australia. Together, these three markets have reached scale, growth, and profitability, where segment reporting gives investors a much clearer view of how they will drive upside going forward. We are also introducing adjusted EBITDA for each segment. This metric aligns with how global peers report their financial services business and helps investors see the underlying profitability of each engine. Transparency builds trust. By separating the two engines, we make it easier for investors to value each segment on its own metrics and unlock the true value of the platform we have built. Now let me discuss each of the segments. China. The macro backdrop was broadly stable. GDP growth of 5%. Consumption sentiment holding its ground. Our China business continues to work through the reset and begin in the second half of 2025. Loan origination volume was largely flat quarter-on-quarter. Given Q1 seasonality, this is a resilient outcome. Net revenue came in at 2.2 billion, up 7% sequentially. Take rate rose from 3% to 3.2%, supported by the better risk performance. On risk, the picture is consistent across indicators. In the first quarter, vintage delinquency eased from 3% to 2.7%. Day one delinquency improved from 5.5% to 5.2%. The 30-day collection rate ticked up from 85.9% to 86.8%. As a result, M2 flow rate declined from 0.77% to 0.68%. On the funding side, we continue to maintain stable partnerships with a broad base of financial institutions, which kept funding costs stable during the quarter. This healthy risk environment allows us to selectively broaden our credit appetite. Targeting has sharpened. Conversion has improved. New borrowers rose 7% sequentially, even when we actually reduced sales and marketing spend in China. Overseas segment. Overseas revenue was up 35% year-over-year. At expanding margin, adjusted EBITDA was 47.5 million, up 87% year-over-year. More encouragingly, all three markets contributed to this profitability. The deeper picture is in how we deepen our integration into local ecosystems. We are embedding our financial services into the daily life and the commerce of each market. This plays out across three consistent themes. First, customer upgrading through targeted product development. Across all markets, we are systematically shifting our portfolio toward better quality borrowers. This is not a collection of one-off products. It's a consistent push towards higher quality portfolio composition. In Indonesia, offline buy now pay later remains the primary growth engine, despite Ramadan, a seasonally slow period. Both transaction volume and the loan balance grew 5% sequentially. Customer quality improved and the take rate held steady, even as headline PMI eased modestly to 15.1. Unique borrowers reached 3.2 million, nearly 5 times the level of the same period last year. Second, regulator preparedness as a core capability. Our regulator playbook is being applied again in the Philippines. We tightened the loan origination ahead of the new pricing regulation, and the early read on risk indicators suggest the caution is paying off. We have navigated a pricing transition in Indonesia and China before, and we are approaching one with the same posture and the same quiet confidence. Third, our proprietary risk infrastructure, refined over years in China and Southeast Asia, is being gradually deployed in Australia. Credit trends there have moved lower for last quarter's seasonal peak, a validation of the portability of our infrastructure. With a renewed credit model, we still achieved sequential growth in transaction volume despite seasonal softness in the first quarter. Finally, our funding ecosystem continues to expand. We have recently added a prominent international bank to our funding partnerships in the Philippines. We are encouraged by the shared mission of our partners to support the exciting growth of the digital credit industry in the country. On a group basis, net revenue for the quarter reached 3.2 billion, marking a 6% increase sequentially driven by an improved take rate. Operating profit improved by 30% quarter-on-quarter to 547 million, offset by impact of FX fluctuation. Net income reached 421 million, up 1% sequentially. On shareholder return, since 2018, we have continuously returned value to our shareholders through share repurchase and dividends. Recently, our board of directors approved our 8th annual dividend in the amount of $0.306 per ADS, reflecting a DPS increase of 10.5% year-over-year. This dividend was distributed to May 7, 2026, bringing our total dividend distributions to shareholders for fiscal year 2025 to $74.5 million. As of the end of April, we have deployed $54 million towards share repurchase, reflecting our conviction in our business and the commitment to our shareholders. Outlook. For full year 2026, we reiterate our revenue guidance in the range of 11.5 billion to 12.9 billion. We are on track toward our 2030 ambition, 15% of group revenue from overseas markets. To conclude, China continues to provide a resilient foundation and is steadily finding its footing. Overseas is scaling profitability alongside it. The combination gives us the stability we need today and growth we are building for tomorrow. We step a quarter deeper into the year with a confidence that is quieter but firmer, in the resilience of our model, in the discipline of our execution, and in the partnerships that carry us forward. Thank you. Now back to the operator for questions.
Thank you, management. We will now begin the question and answer session. To ask a question, please press star 1 and 1 and wait for your name to be announced. For the benefit of all participants on today's call, if you wish to ask your questions to management in Chinese, we ask that you please kindly repeat your question in English. One moment for the first question. The first question comes from the line of Alex Ye from UBS. Please go ahead.
管理层早上好，感谢给我这个提问的机会。我这边2个问题，第一个关于回购的，就是也很欣喜看到就是公司在一季度保持了像去年4季度一样比较快的一个回购节奏。请问能不能给我们展望一下后续在回购的一个安排，然后具体的节奏上会有什么样的考量或者有什么变化吗？那第二个关于这个监管的一些展望吧。那今年以来也看到这些有持续的一些监管文件的出台，包括近期出台的一个金融产品网络影响管理办法。那能不能给我们这个分享一下这个文件在哪些方面可能对公司的经营带来影响，以及公司计划如何去应对？谢谢。So I'll translate for my question. First one is on buyback. So we are glad to see the company has maintained its pace of buyback in Q1 similar to previous quarters. So can you give us some color in terms of the outlook and including the pace for your buyback in the coming quarters? Second question on the regulatory outlook. So we have seen several new regulatory documents coming up in past several months, including the latest document, which is so-called the management rules on the online marketing of financial products. Could you share with us what impact could this regulation document brings to your day-to-day operations, and how would the company react to mitigate the impact?
Okay, thanks, Alex. Yeah, I will take your first question, and the team will take your second question. And your first question is about the buyback. Yeah. On the buyback execution side, as you have seen, we have been running a very pretty active pace since the fourth quarter last year. We did around $14 million in the fourth quarter, and the momentum has carried into 2026. In the first quarter, we executed another $39 million, and by the end of April, we have added another $15 million. So the total amount this year is about $54 million, and the remaining capacity and our current program stands at about $20 million. With that as the backdrop, our board recently approved a new $150 million program, and also as for 2 years. It's quite similar to the 2 programs we did in 2023 and 2025. And on the capital allocation, our goal is always to maximize the shareholder return. The return accretion could come from business expansion, especially from the overseas business. And it could also come from the share repurchase at the dislocated price. So we will make sure we have enough firepower to support the business expansion, and then deploy the buybacks in a more flexible ways based on the liquidity and the price we trade. It would be dynamically balanced. Okay.
Hi, Alex. As you mentioned, the online marketing of financial products, we think this regulation is a natural continuation of a long-running trend. The core ideas, I think, are protecting consumers, ensuring only licensed players offer financial products, and keeping a clean line between tech and finance. And all of these we agree with. Right now, I think it's still early to determine the full impact. The industry is working through the details on execution. And on generally, we see three broad areas where the industry will adapt. First, marketing rules are getting tighter. Things like low barrier to entry and instant disbursement and zero cost are out. The days of flashy, borderline misleading advertisements are fading. For the industry, that means higher compliance costs, and some players we think may need to make some adjustment to their processes. Our approach has always focused on responsible lending and long-term brand building. So we see this as an opportunity to raise our standards even further. And second, on user traffic flow from a platform to lenders. The rules add some fiction. It requires third-party platform to refer users directly to the financial institution's own platform. A lot of details still need to be hammered out on implementation. So it's too early to say for sure, but we are working with financial institutions and the internet platforms to restructure some of the workflow under this renewed framework. There will certainly be some adjustment to the process. We are in close communication. And the third, on business boundaries, the regulation reinforced that core financial decisions, such as credit approval and the risk assessment, must rest with licensed financial institutions. This has always been our model. We provide the technology and data tools. Our partners make the final calls. And overall, this regulation raised the bar for the entire industry. There would be adjustments near term. But as a company, FinVolution as a company with strong compliance and technology infrastructure, we see it as a net positive over the medium to long term. And thanks, Alex.
Thank you for the questions. One moment for the next question. Our next question comes from the line of Cindy Wang of China Renaissance. Please go ahead.
谢谢管理层给我这个提问的机会。那我这里有2个问题想请教。第一个问题就是可不可以给管理层给我们一下，就近期国内这边4、5月的一个风险表现，那有机会持续在第一季度的一个基础下持续向好吗？那风险向好的情况下的话，第2季我们怎么看国内的一个新放贷款量？然后第2个问题的话是我们注意到就这次公司做了这个分部的一个披露，那可否请您分享一下关于这个分部披露背后的一个考量？然后海外的话，这边可不可以帮我们介绍一下目前的一些APR、funding cost 跟违约率的一些指标？那预计2030年的话，这个 EBITDA 占比可以贡献到集团为多少？那我很快翻译一下我的问题。Thanks for taking my call. I have 2 questions. First, could you let us know whether domestic risk performance in April and May continue to improve from first quarter? And then if credit risk improves, will transaction volume in China in the second quarter would increase? And second, we noticed that the company has made segment disclosure this time. Could you please share the consideration behind the segment disclosure? And also, could you please introduce some operating indicators for overseas markets, including like APR, funding costs, and default rate? And then what percentage of the group's EBITDA is expected to contribute from overseas market by 2030? Thank you.
Okay, thanks, Cindy. I will take your questions. Your first question is about the domestic business. Yeah, when we look at the risk performance in the second quarter, the improving trend is continued. Yeah. The asset quality has continued to get better, and by the end of April, our day one delinquency had already fallen below 5%, back to where we were in July and August of last year. The sustained improvement in the asset quality is really the reflection of the risk management we have been building across the full credit life cycle. On the front end, customer acquisition and the pre-approval, we have been actively moving up the credit quality curve, offering higher limits and better pricing to those high-quality customers. And on the technology side, we have been leveraging the large language model to refine the risk analysis, fraud detection, and intelligent post-loan collections, which has meaningfully lifted both the business efficiencies and asset quality. As the asset quality stabilized, we have selectively raised our risk appetite in the second quarter. We are now running a diversified approach backed by the AI models. For those high-quality existing borrowers, we are now offering more credit limits at a controlled pace. And we also selectively offering a wider group of customers of reasonable credit quality to expand our potential customer pool. So we are making progress on sustaining the first quarter growth momentum into the second quarter, and we will keep a close eye on the macro environment and our early risk indicators. Stay focused on the high quality growth and continue to keep the balance between volume, risk, and profitability. Okay. And your next question is about the overseas business. I think it's the multi-part question, so I will break it into three pieces. Yeah. First is about the overseas operating metrics. Yeah. We will not break our APR funding cost or risk by market because each is very different from interest rate to borrower profile. But I will give you some high-level guidance for reference. For APR, compliance is always our first priority. We strictly follow the local pricing rules. At the same time, moving toward high-quality customers will give us the flexibility to offer different price. Take the buy now pay later product as an example. It helps us reach more prime customers. And for the funding cost, more institutions recognize our asset quality. And our funding partners go from 13 in 2004 to 18 today, which is continuously optimizing our funding cost. And for the delinquency rate, as we upgrade customer quality and advance our risk capabilities, the risk metrics are improving across all markets. We continue aim to progressively bring this down going forward. Okay. And the second part is about the EBITDA contribution. Okay. For 2030 overseas EBITDA, I think it's still too early to guide on that because it depends on too many variables. The contribution from our Chinese business, the accounting rules impact, and the pace of the overseas business. But for 2026, we have a very clear target. Yeah. But if you look back over the past few years, you will see a very clear roadmap. We clarify our strategy, and then execute it, deliver the results, and report them. So second disclosure is a natural milestone in that ongoing narrative. When we look back at our international journey, it goes like the step one, prove and replicate the operating model. We first prove the viability and the profitability of our business model in Indonesia. This was our first 0 to 1 breakthrough in an overseas market, and then we replicate the success to the Philippines. And step 2, we set a long-term goal and deliver the steadily. As our overseas business took shape, we formulated a group strategy to guide operations and growth, our local excellence, global outlook, or legal strategy. We also clearly laid out the goal of reaching 50% overseas revenue by 2030. We are now already at 30% today, steadily on track. And step 3, the full strategic upgrade to legal plus. As we expanded into developed markets like Australia, we have made a fundamental upgrade to what we call legal plus. We moved from being a collection of local wins to an integrated platform with compounding platform-level advantages. So under this framework, regulator experience, product structures, risk capabilities, and funding networks, all validated in new markets, can be systematically reused and migrated to new markets. That has great accelerate and de-risk the new market entry. And the next step, the formal segment disclosure. Now, we truly run a business that is both high growth and profitable on its own. That's the right time to provide separate disclosure for better understanding of the value in that business. And this segment disclosure is a nature link in our overseas story. It ties together what we have done and where we are headed. It validates the success of our legal strategy to date, and it provides the transparent window into the high-quality global growth we are building for the future. In the coming years, you will see that our overseas engine is not only fast, but also increasingly profitable, with unit economics that keep improving. Okay, thank you.
Cindy for the questions. One moment for the next question. Our next question comes from the line of Yujie Jing from CICC. Please go ahead.
感谢公司给我提问的机会啊，我这边有一个关于海外市场拓展的问题，想请教一下管理层。咱们海外业务已经实现盈利，那请问接下来推动海外业务持续增长的驱动力是什么？能否请管理层帮我们展望一下海外业务的前景？Thanks for taking my question. I'm Beijing from CICC. I have a question regarding overseas market expansion. Now that our overseas business has achieved profitability, what will be the key drivers for its sustained growth? Could you also share your outlook for this business? Thank you.
Thanks, Yujie. I will answer this question. As previously mentioned, our overseas business continues to deliver strong and resilient growth. And over the past 5 years, from 2020 to 2025, overseas transaction volume grew at a 69 CAGR. In the first quarters of this year, despite the seasonally slow period, we still delivered solid results. And revenue grew 35% year over year, with EBITDA up 87%. And overseas business is now the group's second largest growth engine. The co-driver behind this growth is a dual flywheel loop we built as a data-driven tech platform. With over 56 million registered users, our growing data pool sharpens our risk models. And high-quality assets consistently attract more institutional fundings. More capital at better cost allows us to serve broader and higher quality customer segments. Across Indonesia, the Philippines, and Australia, we will graduate from the early investment phase and now profitable. And for Indonesian market, after fee adjustments in the past years, growth has resumed. The first quarter transaction volume grew over 30% year-over-year, and our approach is to proactively pursue higher quality customers, and continuous traction of our offline buy now pay later product is a direct result of that strategy. In the first quarter, offline buy now pay later volume doubled from last year. And the Philippines, we proactively adjust our lending pace in the first quarter, and ahead of the new interest rules, it take effect in the second quarter this year. Even so, transaction volume still grew on double digit year-over-year. We also broadened our funding sources with one new international bank, a clear recognition of our asset quality. And for the Australian market, we are systematically deploying our fintech expertise and risk management capabilities, automated system, and funding capacity from the group. And the first quarter transaction volume grew 25% year-over-year, with more local data and ongoing model improvements. We are confident Australia will continue to grow in both top line and profitability. And looking ahead, as our business scales, the flywheel loop would accelerate. Our long-term vision is to become a global example of technology-driven, inclusive financial platform. Operating on multiple fronts globally comes with challenge, but we are mature tech mode. But with our mature tech mode and operational agility, we are very confident about the journey ahead. Thanks, Yujie.
Thank you for the questions. As there are no further questions now, I would like to turn the call back over to the company for closing remarks.
Thank you, Desmond. Thank you once again for joining us today. If you have any further questions, please feel free to contact our groups and our team. Thank you so much.
That does conclude today's conference call. You may now disconnect your lines. Thank you.